Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. It's the 15th of December 2023 and here are the questions we will be answering today. What did India gain from COP28? Why has IT hiring slowed down? What does the Fed pivot mean for Indian markets? And how is phase out of fossil fuels different from phase down? Over 200 countries at the COP28 Climate Summit have for the first time agreed to transition from coal, oil and gas. The deal was clinched miraculously after the summit's closing hours and ended with a 2-minute standing ovation. While it could be a big step towards checking global warming, what did India gain from COP28? Shivam Tyagi finds out.
A beginning has been made at the COP28 Climate Summit, and some believe it's the beginning of the end of planet-warming fossil fuels. It has also kindled hope that the world may be able to limit global warming to 1.5 degrees Celsius. Leaders of over 200 countries spent over 2 weeks in Dubai to thrash out contours of a pact, which puts the world on a path to slowly move away from burning oil, coal and gas for energy. And it has been achieved at an unlikely place, Dubai. For the first time, a consensus has been reached on transitioning away from fossil fuels at the United Nations Climate Change Conference. Norway's Foreign Minister Espen Barth Eide said that it was the first time that the world has united around such a clear text on the need to transition away from fossil fuels. But developed countries wanted stronger language. They wanted to phase out fossil fuel, something that was opposed by oil producer group OPEC. But critics believe that key highlights of the final document were vague terms and insufficient financing.
So if we have to summarize this COP or if we have to say it, then yes, fixing the accountability is one of the issues. And more importantly, the issue is with ambiguity. Ambiguity in terms of defining what the targets are, by when these targets are, and by more importantly, by how. Once you address this first when, how, and what, then comes who is going to do it. Right, whether it is the developed countries supporting or at least committing or standing true to the pledge or going forward. So all of these are very, very important to address at this point of time.
Although the world remained divided on the text of the final document, India sure has some wins this year. Apart from transitioning away from fossil fuels, the document also called for phasing down of unabated coal power and inefficient fossil fuel subsidies in a just, orderly and equitable manner. According to reports, India has particularly gained on many fronts at this year's COP28, like omission of a line in the final text of the COP28 document which limited generation of coal power through new thermal plants.
So India pushed back. And this time, because there is a language on fossil fuels and transitioning away from that, the language on coal is now being balanced in a manner where we are talking about phase down. And in the previous version, there was a reference to rapid phase down and limitations on permitting new and unabated coal power generation. That has also been removed. And the main reason for that is India and other countries are trying to link it with finance. If finance is not provided and rich countries do not do as per their fair share, it is unreasonable and unfair to put pressure on countries that are using coal. So we have to bring that balance.
Additionally, developing countries can also use natural gas as a transition fuel for a smoother shift from carbon-intensive fuels. The green fuels push in the document is also a plus for India and its plan on biofuels like blending petrol and ethanol. Out of the 10 declarations signed at COP28, India was only part of 2. It gave a miss to crucial declarations such as health, climate change, and renewable energy. While India strives to be a $5 trillion economy, it is growing at a cost. The country's 75% electricity is coming from burning coal. As reported by Business Standard earlier, India accounts for 7.6% of the global carbon emissions, although the per capita emissions of the country remain one of the lowest globally. Developing nations like India are also set to gain from technology transfer. Some of them are carbon removal technologies, subsuming carbon capture, utilization and storage, and low carbon hydrogen production.
The biggest win for India is in terms of providing a push for technology transfer. Until now, what was happening is the developed countries were polluting. Then they were bringing in a technology. That technology had to be adopted. It was always a one-sided track. It was never a two-way traffic. But now developing countries like India have a stand that given there should be some of the equity and those cost sharing should happen at a technology level. In order to have that technology, you need to have a technology transfer mechanism on card. So this is very, very important win for India that the technology transfer part is been taken up, whether it is battery storage or biofuels or alternative energy sources. These are real key wins. And India as a country has got huge potency for raw materials for some of these technologies that needs to be brought in from margins to mainstream.
India aims to reach net zero emissions by 2070, and by 2030, it plans to meet 50% of its electricity requirements from renewable energy sources. Clearly, the country is on the track towards a greener future. Meanwhile, the flexibility it has got in COP28 will help in a smooth transition while maintaining the growth trajectory.
Several researchers have claimed that global warming will hit the economic growth adversely and lead to joblessness. Speaking of jobs, hiring in India's IT sector has hit an all-time low. Kasturi Akhil digs deep to find out what's behind this dip in hiring.
After significantly curtailing campus hiring this year, the Indian IT industry has hit an all-time low of 14% in terms of its gross hiring addition over the past 12 months. This is sharply down from a peak of 40% in 2022 and far below the 2017-19 average of 21%, a study conducted by US-based IT analyst firm ISG found. This comes in the wake of overall job market concerns in India, following comments from major players like Infosys and Wipro that suggested further decline in IT services hiring until March 2024. The once booming IT industry is witnessing a dip in discretionary spending amid prevailing global economic slowdown. As a consequence, tech giants that engineering graduates have turned to since the IT boom in India have deferred onboarding freshers this year. In the opening week of Q2 earnings season of FY24, TCS and Infosys reported a sequential decline in employee count. Wipro and Infosys said they will abstain from hiring college freshers this year. TCS opted a cautious approach by scaling down its hiring target to 40,000 for FY24, a significant drop from hiring around 1 lakh freshers in FY22. While entry-level hiring has taken a hit, IT companies have maintained stable attrition rates, maintaining new employee figures at pandemic lows.
I think the attrition rates have gone down, the growth has gone down, Europe has gone slowed down. There is a reasonable, I would say, caution which is there in US because US is expected to get into recession. So I would say there is a lot of, I would say, cautioned approach which IT services is taking because they are not very sure that how US will respond in 2024. And that's why they have applied a lot of brakes to ensure that they do not have to go through the process of layoffs, which our startups went about. Or if you notice, startups hired a lot earlier, but our IT services was always in a moderate mode. So I think they've applied the brakes, and hopefully it will get revisited as the economy recovers overall.
In 2022, the IT industry witnessed what is being called the Great Reshuffle, wherein 40% of the IT services workforce stayed at the company for less than a year. This was because before the pandemic, IT companies overly relied on campus hiring in anticipation of future demand. And during the post-pandemic boom, they also turned to competitors for experienced lateral hires. As a result, companies are now upskilling and reskilling existing employees to redirect their force to optimization efforts. A recent report by Quest Corp highlighted that the Indian IT sector is hiring more apprentices instead of full-time employees to cut workforce costs and cultivate employee allegiance and retention. According to the report, the IT and ITES industry has seen over a 250% annual increase in apprentice headcount this year, and about 79% employers foresee a further rise in apprentice roles in the coming months.
What we saw happening during the COVID time, in your first 6 or 12 months at any organization, especially if it's your first job, you're not really being super productive. You are mostly learning, right? And what this company saw is that after the first year, most of the people exited to get better offers at other companies. So there are a couple of things they're doing. One thing they're doing is that instead of giving an offer letter, they're giving a letter of intent. So they are mentioning that, okay, I intend to hire you given that you finished so-and-so training. And second thing they're doing is giving apprenticeships or internships or whatever we can call them. And the reason for that is, of course, the salary of an intern will be much less compared to a full-time employee. So in this learning phase, they don't have to pay a full salary. The experience also on the resume of the person shows as an internship. So the ability for them to go and jump the gun after 3 to 4 months of internship is reduced.
Hiring slowdown is primarily observed in entry-level job roles within IT companies. They are instead hiring aggressively for niche technology-based positions like artificial intelligence, Gen AI, and cloud computing, while upskilling the existing employees and helping them elevate to higher positions.
But the IT industry heaved a sigh of relief after the US Federal Reserve decided to maintain its key interest rate for the third consecutive time on Wednesday. The US Federal Reserve is finally shifting gears towards a policy pivot with a dovish commentary in the latest policy meeting, where it laid out the rate cuts projections for 2024. With Indian equities sustaining their record-hitting spree, what does the Fed pivot mean for markets and which segments will lead the charge? Harshita Singh tells us in this report.
The much-awaited US Fed policy pivot and a tone of finality to it has sparked a sharp rally across global equities and treasuries. The US Fed stayed put on policy rates on 13th December and laid out a projection of rate cuts of 75 basis points over 3 meetings next year, higher than the earlier September forecast of 50 BPS cuts. This will reverse a rate hiking campaign that took the Fed rate to the highest in over 22 years. With markets now expecting the first cut to come as early as the March meeting, domestic equities are set to lead emerging market inflows next year, analysts believe.
Market participants are already pricing in that the Fed will be cutting rates, or most global central banks will start cutting rates starting from March 2024. And within that, I think it goes without saying that that will provide an element of slight weakness in the US dollar, which is always a kicker to emerging markets. India has remained the bright spot this year in 2023, with the MSCI India gathering more than 50% of all inflows coming into emerging markets from foreigners. And I think India will be the shining beacon within EMs, and it will outshine developed markets in the next 12 to 14 months as well.
On a year-to-date basis, the MSCI India Index has rallied 15% this year, while the MSCI Emerging Market Index is up just 2% in comparison. In terms of equity market pockets, the robust momentum from both domestic and foreign investors is likely to lead to large caps staging a strong turnaround, analysts add.
I think in the emerging market basket, India will definitely command a large portion of the flows that will come in for multiple reasons that we all know, be it interest rates, be it inflation, be it the stability of the government, though we are going in for the election, big election next year. So I think new funds coming into the domestic institutional investors and foreign institutional investors, their primary focus is going to be large cap by default. So you are going to see possibly some kind of a catch-up rally, as we call it, by the large caps compared to the mid, small and micro caps.
Notably, on the bourses, large cap stocks have remained underperformers this year as against their mid cap and small cap peers. Top large cap gainers are Tata Motors, NTPC, L&T and Power Grid, which have surged 62 to 85% so far in 2023. Mid cap and small cap peers like Jai Balaji, Orient Pro Solutions, REC, PFC and SJVN have outperformed by soaring 270 to 1000% in this period. VK Vijayakumar of Geojit Financial also expect the large capital flows to India to mainly benefit large caps, particularly the fairly valued stocks in the banking pocket. IT too is likely to attract buying while there is no valuation comfort in mid and small caps, he says. Thus, the Fed pivot is expected to extend the recent strength in markets, with analysts betting on large caps given their valuation comforts and strong fundamentals. Today, on 15th December, global cues and stock-specific action will dictate trends on Dalal Street.
He's making plans for an early retirement. Business Standard.
Moving on, as the global community intensifies efforts to combat climate change during the COP28 summit, discussions surrounding the reduction of fossil fuel usage have gained prominence. Two terms frequently mentioned in this context are phase out and phase down. While both aim to address the environmental impact of fossil fuels, they have distinct meanings and implications. Abhijit Kumar decodes the difference between the two.
Before a breakthrough was achieved, the discussion on fossil fuel usage was at a standstill during the COP28 summit in Dubai. The COP28 meeting initially was aiming to restrict the temperature rise within 1.5 degrees Celsius from pre-industrial times. So, an agreement from the participating members on a time-bound phasing out of fossil fuel usage was essential for this purpose. However, the oil-producing nations strongly objected to any mention of a fossil fuel phase-out. The first draft agreement at the summit called for a phase-out of fossil fuels, which was rejected by oil-producing countries like Saudi Arabia. The next draft edited the phasing out and asked the countries to reduce the production and consumption of fossil fuels. But the language was considered weak and rejected by the European Union and a few small island countries. In the latest draft, the recommendation is to rapidly phase down unabated coal and a transition away from fossil fuels in energy systems. The term phase out refers to a deliberate and complete cessation of the use of fossil fuels. It implies a comprehensive and systematic elimination of dependency on coal, oil, and natural gas. While a phase out refers to a radical reduction in fossil fuel burning down to zero or as close to zero as possible by a certain date, a phase down is a weaker term that indicates a decline in fossil fuel burning without specifying by how much or when. The difference between the two terms is that a phase out means complete cessation, while a phase down means a structured reduction in the use of fossil fuels. Countries and organizations committing to a fossil fuel phase out will have to set specific targets and timelines to completely eliminate the use of these energy sources. This will involve transitioning to renewable and sustainable alternatives such as solar, wind, hydro, and geothermal energy. Hence, the objections from the oil-producing nations that rely on the money brought in by oil and natural gas. While in phasing down, instead of an abrupt halt, a phase down approach involves setting specific targets to incrementally reduce the share of fossil fuels in the overall energy mix. This strategy acknowledges the challenges associated with an immediate transition and allows for a more gradual shift towards cleaner alternatives. But there are no specific timelines or targets. Both phase-out and phase-down strategies play critical roles in achieving international climate goals outlined in the Paris Agreement. But with countries lagging behind on the climate goal targets and climate change incrementally affecting each nation every year, the choice stands clear.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
After the COP28 declaration, the UK Climate Minister Graham Stewart went on to claim that it was the beginning of the end of the fossil fuel era. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.